I want a bigger home, but I love my 3% interest rate. That's what we keep hearing from homeowners that want to make a move, but love that low interest rate. So today we have Julie Aragon, mortgage broker with Aragon Lending, to answer some of the questions and go through some options that you may have if you're thinking of moving up. Life is like Monopoly, every move counts. I'm Gia Silva, real estate broker and investor, and I have helped hundreds of people make winning, smart real estate moves. Julie, it's so good to have you back.
Thank you.
And today we're gonna be discussing move-up buyers. So really someone who's already a homeowner, right? And is thinking of either getting a bigger home or just moving.
Yeah.
And they are in love with their 3% interest rate or even 4% interest rate. So what are some of the things that you go through or the exercises when someone comes and goes like, oh, what would that look like if I buy a bigger home?
So it depends. It depends on if the client intends to keep the home and turn that into a rental, or they know they need all of the money from that sale to buy their next home.
Got it.
So really having a conversation to see what the plan is, and then we can go through the different approaches.
Okay, so then what are some of the exercises that you do for both? Let's just say someone goes, okay, well, I would really hope that I can keep this home, right? Because I have the 2 or 3%.
Yeah.
And I want to keep it as a rental, right? Because my payment is low and I know I could rent it for much, much more. What's that exercise that you do to see if they can even do that and then also afford a second home?
So one, to see how much other money do they have available. Maybe if they don't have as much cash, maybe we get a HELOC on the current primary while it's a primary, with the intention that we're going to use some of that money to put a down payment on the purchase.
Okay.
Or maybe they have other money saved. Maybe they're going to come into an inheritance. You know, we have to look at like what money we have and then see, okay, on that new purchase, with the money we have, is the monthly payment affordable?
Yeah.
And you're right, some of our clients, they know that they'll be positive because they owe so little, and you know the cash flow will help subsidize that payment on the new home.
You know what, so just going back to that, so let's just stick with those homeowners who are thinking, yes, I definitely want to keep this home as a rental, right? Because I have a low payment. How does a lender look at that when they're trying to qualify for another property?
Yes, great question. So the lender is going to use 75% of the market rent.
So they won't take 100% of the market rent.
No.
They'll take 75% of what that market rent will be.
Right.
Okay.
And then we'll use that to offset the payment.
Got it.
So a lot of times for most people that may be just a wash. If there's positive rental income and you don't have a history of being a landlord, I can't use that positive rental income.
Yeah.
But just offsetting the payment is a big help for most people.
Got it.
That'll allow them for the ratios to work for the next home.
Okay, Julie, so you mentioned that the lender will take in consideration 75%, right, of the rent. So let's just say someone has a mortgage payment of $3,000, and then after looking at market rents for that property, they know that if they rented that property, they could probably rent it for $4,000. So what would that look like for a lender?
Right, so if gross rent is $4,000, 75% of that is $3,000.
Okay.
If the mortgage payment is $3,000, now it's a wash. So it's not going to hurt them debt to income wise.
Got it.
And then they can purchase a new place. Now, let's say their mortgage isn't $3,000. Let's say it's only $2,000. Well, now they have, you know, on paper, they have more money to help with the payment on the new place.
Yes.
But the lender's only going to give you 75% of market rent
of
for
market
qualifying.
Rent for qualifying.
Yeah.
Got it. Perfect. Okay. Now, have you seen a lot of cases where someone is able to now have those two mortgages?
Yes. So I would say most of the deals we did last year were situations where there was enough income to qualify for both payments. Not to say the clients wanted that situation or, you know, long term.
Yeah.
But on paper, they could qualify. And so what that allowed them to do was to find that new home first, you know, move out, get it staged, do whatever, and then sell the home. Now we've got all of these proceeds that we can put down on the new home, but not having the stress of having to move potentially twice or be rushed to find that replacement home.
Got it. Okay. Now, what does it look like? I'm really curious about this. What does it look like for someone that goes, okay, well, my goal is going to be to sell this home now. So I'm not going to keep it for rental purposes. I want to sell this home now. But because of the market or where I'm looking for that new home, I know that a seller is not even going to entertain my offer if I'm contingent on selling the home, if I need these proceeds, right, to buy that new home. So what are some options that someone has in that case?
So let's say your current home, you owe $500,000 at 3% rate, and you can sell it for $900,000.
Okay.
So you're gonna net approximately $350,000 after. If you buy the new home at 1.2 with 10% down, your payment is $71.85. Now, after selling your home, you've got this money, you call the lender. Usually the fee's a few $100s. It's not nearly as much as to refinance, and you're able to recast or re-amortize that loan so the payment drops.
Got it.
Okay? And so let's say if you took all of that money, your payment is gonna drop to $48.83.
Wow. So after you sold.
After you sold.
So you qualified with both properties, right?
Yep.
But then after you sell that property that you wanted to sell initially, now you take the proceeds and then you pay down that new mortgage that you have of that new property.
Exactly.
Which brings down your payment like $3,000.
Yes.
Sounds like.
Thousands of dollars. So, and you might decide, okay, well, I want to pay myself back that $120 that I put down. We can talk about the math and what's better, how much to keep, but you have options. If the income's enough to support both payments, you're in a really good place because you have some options.
Okay. So Julie, what if they didn't count on, more funds or more money to come together so that they could qualify for both mortgages?
So depending on how much equity they have, they might be able to do a bridge loan.
Okay.
Usually those come with high costs, but it can be done.
So the bridge loan actually what it does is gives you that like down payment up front, right?
Yes.
To be able to buy that second home.
Right.
And then afterwards pay that first mortgage off.
Exactly.
Okay. But then you're saying that the rates are really high, cost is really high for a bridge loan. So then would you suggest to look at other avenues, right? Like you're saying other things to do first before even going that bridge loan route?
I would, yeah.
Okay.
Definitely.
Perfect.
So another thing to think about is to ask yourself, do I really have a 3% rate? Because you might have a 3% first mortgage, but in the last couple of years, you took out a HELOC that's at 8 or 9%. Okay. You may have got new windows, you have credit card debt, things like that are at 20, 30%. So when you look at your full financial picture, you might not have a true 3% anymore.
Yeah, that's true.
So when you're talking to a mortgage broker, they can run the examples of, okay, we're gonna pay off all this high interest debt. You're not gonna have that HELOC anymore. Yeah, maybe we're going from, a blended interest rate of somewhere you might have 4 or 5% on all your debt to a 6.5. It's not going double, when you look at all the debt.
And especially when you think about, I always say this, right? When you think about hundreds of thousands of dollars that you're borrowing for 6% or 6.5% compared to the 18, 20% that you have on credit cards and on other things that, don't appreciate for you, right? So that's a really good point. So what you're saying is, go through that exercise, right? Of figuring out like, am I really paying the 3% interest rate that I'm so attached to? Yeah. Right? Or do I have all of these other debts that I've collected throughout the years and put them together to go, well, it's not really 3% interest rate, right? Right. All combined is 5%, 4 or 5%. Yeah. So yeah, that makes a lot of sense. That's another perspective. Yeah.
Because sometimes we tell ourselves like, oh, I can't afford, I'm not willing to give up at 7%. But like, what does that mean? Yeah. Like, what is that 7%? So when you lay out all the numbers, maybe it does, when rates are 7, maybe it doesn't make sense for you to be a seller and move up. But after you talk to somebody like me, you can say, okay, but if rates hit 6.5 or 6.25, I'm calling Gia up. Like that's the time because I've already done the work. You don't want to do that when the house that you always wanted goes up, the sign goes up and then it's panic. So
yeah, and again, it's also the perspective of people are so attached to that number, to that interest rate, without considering, well, what about the lifestyle that you want, right? Like it could be a lot of fear-based, like we've spoken about. But yes, it's putting things in perspective with not just finances, but also like livelihood, right? Yeah. What is that gonna look like for you to finally move up to that bigger home and have little Johnny have his own room? Okay, Julie, I have to know. I gotta know what you believe as a mortgage broker is going to happen in 2025. So give me some of your forecasts.
I think we're gonna see rates in this range for a little bit longer than we hoped.
Okay, so like 6.5 to 7%. Yeah, just about. Okay,
I think so. I think we had kind of hoped that there, maybe we'd see the 5s, but with inflation being a little stubborn, and jobs appearing like they're, the economy's healthy, I think we are gonna see interest rates
stay around there, 6.5 to 7%.
Which I think people have kind of like. At least the newer buyers are getting used to, right?
Yeah, absolutely. When they went up, they learned their lessons because when they didn't end up buying in 2020 or 2021 where the rates were super low, they believed that home prices were going to come down, and that just didn't pan out.
Right.
So because it didn't pan out, it seems like now people are like, well, I don't want to be out of the market again and miss on that whole appreciation that all these people gained in those years. Right. So I'm guessing that that's going to be another consideration this year too.
Yeah. And I think it's so important to make sure you're working with the right team, because I'll tell you, like, I talked to a client, I remember in December, and he said, I was working with an agent for 3 years to try to get an offer accepted. So you think about it, if you started shopping for a home in 2020 and you couldn't, you were with them, what did that do to like your purchasing power and rate? So making sure you have the right people on your team, because having the wrong people could cost you tens of thousands, potentially hundreds of thousands of dollars. That is such a good point.
Absolutely. That is such a good point. People have been shopping for years and years, and then they become really sad at like, okay, my offers didn't get accepted. I'm just going to put a hold on my search. And they could have had that home, right? Appreciate and had that 3 or 4% at the time. But don't miss out. I mean, if you can afford it, you would say, buy a home. If you can.
If you can afford it,
So you're saying that you believe they're going to stay interest rates about 6.5% to 7%. What else can you forecast as a lender? What else do you think is going to happen in 2025?
I do believe that property values are going to continue to go up, maybe not at a crazy pace. I think locally we're going to see a lot of people affected by the fires coming down towards us a little bit more. We have clients right now that are renting in that area and now looking in Long Beach. So I think that's good. It's going to be good for if you have property and for rents and those maintaining, as well as for home buyers.
So I'm sure there's people out there that have a specific scenario. So if you have a specific scenario, you've been thinking, I want to keep my 3%. Can I even afford another property? Should I keep it and rent it? Make sure you put your comments below. Contact Julie, contact me, get your partners together, get your team together that's going to help you navigate through the process to figure out if it's the right time for you to do it and what that looks like. So if you found the video insightful and helpful, make sure to comment below, maybe your specific scenario, subscribe, like it, and we'll see you soon.